Last Friday, the Nasdaq had its worst day since April 2025. Semiconductor stocks alone lost more than $1 trillion market value in a single session. Not a week, not a month, but one terrible single day. And right in the middle of all that carnage, Bank of America put out two reports that seemed to completely contradict each other, only adding to the confusion. One of their top market strategists came out waving a red flag. She's warning investors to take profits, trim crowded trades, and rotate away from tech. She's comparing today's setup to early 2020, right before that major crash. Then on the same day, the bank's top analyst for tech industry actually raised his target price for SanDisk, and he raised it by a lot. So which is it? Is Bank of America bearish or bullish on the chip stocks? And should you be running for the exits or loading up on semiconductor stocks thanks to this recent dip? So in this video, I'm going to explore both sides of the story. I'll share the chip stocks that still have buy recommendations in my Zen Investor portfolio and why. By the way, I'm Steve Reitmeister. I've been investing for over 40 years. I spent many of those years as editor-in-chief at Zacks.com, and now I'm a partner at WallStreetZen.com, where I help create a quant rating system to help simplify the fundamental research for stocks, which gives investors greater peace of mind. If you like news breakdowns like this one, then please hit that like button. That's my signal to record more videos like this in the future. Okay, now let's get on to the good stuff. Let's start by breaking down the two conflicting Bank of America reports, starting with the bearish one. Now, let me give you some context on who Savita Subramanian is. Hopefully I pronounced that correctly, because she's not just some random conspiracy theorist, right? She's the head of U.S. equity and quantitative strategy at Bank of America Securities. She doesn't cover individual stocks. Her job is to look at the entire market and the institutional clients, what the macro picture looks like. And she has been amongst the most cautious voices on Wall Street this year. So back in December, when most of the street was piling on with 7,500 or 8,000 year-end targets for the S&P 500, she came in at only 7,100. That was the most bearish call on the street at the time. A lot of people laughed, but maybe now not so much. By the way, for what it's worth, I've personally been on the more bullish end of the spectrum about how high the S&P 500 could go this year. This is the type of insight I share in my live weekly training sessions. Totally free and includes some of my top stock recommendations. Please join my next one this Monday at 7 p.m. Eastern Time. Just scan the QR code on your screen to register for free. All right, but I digress. Here's the core of Savita's warning. Bank of America has something called the sell-side indicator. It measures the average recommended equity allocation across Wall Street strategists. It ended May at 56.2%. That was the highest reading since February 2025, a level just before a 1,000-point drop for the S&P 500. It's a contrarian indicator. When the whole street is bullish, history says it's time to get a little nervous. Bank of America's analysts are explicitly telling investors to sell in June. They're pointing to the recent rally that has been dangerously narrow, crowded into the same mega cap and AI names with a 9-week winning streak behind it. They're comparing that setup to early 2020, right before the crash, not because they're predicting a pandemic like COVID, rather because the structural conditions look the same. Overextension, concentration risk, and a market with very little cushion for bad news. That's the warning, but just a few desks over, the story was very different. Who was behind the bullish report on SanDisk? Well, that was Wamsi Mohan, one of Bank of America's top-rated technology analysts covering hardware and semiconductor stocks. This week, Mohan raised his price target on SanDisk from $1,550 to $2,100 while maintaining a buy recommendation. And the reason why matters even more than the sky-high price target. Mohan's thesis is simple. NAND supply is tight, and it's staying tight. NAND wafer starts are declining this year, and no significant new manufacturing capacity is expected until 2028. Meanwhile, demand is growing exponentially thanks to the AI boom. When supply shrinks and demand compounds, pricing goes in one direction. SanDisk has also been locking in long-term supply contracts with the hyperscalers. 5 deals signed so far, representing at least $42 billion in committed revenue. That's not a company fearing the cycle will end. That is a company extending the benefit of the cycle for as long as possible. SanDisk and the other memory stocks like Micron Technology and Western Digital all bounced meaningfully on Monday after the upgrade. And let me add that Mohan isn't just an ordinary analyst. His track record is truly legendary. On WallStreetZen, he ranks in the top 1% of all analysts we track for his stock picking prowess. To be more accurate, he's currently the number 9 ranked analyst out of more than 5,200 that we track. That's because he has a 71% win rate and an average return of nearly 77% per recommendation. Okay, and as a relevant side note, his best recommendations of all time were for SanDisk and Western Digital, the company that owned SanDisk before they spun them off, meaning he has keen insight on the company and the industry as a whole that is certainly worth listening to. Okay, now I'm going to give you my take on this tale of two reports situation. But first, if you like getting insight on major market events like this, then now would be a good time to subscribe and hit that notification bell. That's because I release videos like this frequently, and that is the best way to ensure you don't miss the next one. Now, here's something that may speak louder than words. Two major chip stocks that dipped the other day, Micron Technology, symbol MU, and SanDisk, SNDK, are currently in my Zen Investor portfolio. Despite already significant gains since being added, both still carry a buy recommendation within my portfolio. So I'm not a neutral observer here. I have real conviction in this space, and last week's sell-off did not change that, and here's why. When I look at a stock, I'm looking for the same combination I've been looking for my entire career: accelerating growth, financial strength, and a reasonable valuation. That's what the Zen Ratings quant model is built around. The system puts every stock through a rigorous 115-factor review and distills its fundamentals into a simple, easy-to-read letter grade of A through F. An A amounts to a strong buy recommendation, while an F equals a strong sell. Both MU and SNDK rate highly within the system. As of the week I'm recording, both respective stocks boast an A rating, equivalent to that strong buy recommendation. So this is not me talking up my own portfolio. That's 115 factors, a true quantitative model saying the fundamentals are sound and the upside looks very promising. Now, Savita Subramanian's warning is real, and I take it seriously, but notice what she's actually warning about. She's not saying sell everything or sell every tech stock. She's saying get out of the crowded names, the mega cap AI names that have been bid up to a point where they only work if everything goes perfectly, which almost never happens. Those are the stock price in a dream, and I've been very cautious about that in the market too, as I've mentioned in a recent live training session. By the way, if you want to attend the next WallStreetZen live training session, then please join me on Monday at 7 p.m. Eastern Time. I just don't talk about what I'm buying, but how I'm finding it, so you can do the same in the days and weeks ahead. I also unveil my trade of the week, combining the best of the Zen rating system with my greater than 40 years of investing experience. So, if you're liking this content, I strongly recommend that you pause the video for a minute and register for free at wallstreetzen.com/live. You'll also find a link in the description or scan the QR code on your screen. Hope to see you there on Monday. Back to the topic at hand. Now, here's why the memory arena may be a different situation than those overcrowded AI names. Micron and SanDisk aren't based on some dream of future potential. They are enjoying obscene demand right now from the massive investments in AI and data centers. Every data center built needs massive amounts of memory. That demand is real. It's here today, and as we just covered, the supply side isn't keeping up until at least 2028 when new supply comes online. The Zen ratings model reflects that reality. That's why Micron and SanDisk have strong fundamentals, real earnings momentum, and room to run in the current business cycle. Could these stocks pull back further? Of course. They've had big runs, and volatile markets don't discriminate. That's the risk you have to accept in any stock, in particular in memory stocks. But in my many years of investing, I've learned that when a stock with strong fundamentals sells off because of sentiment, rather than a broken business model, it may not be a reason to sell. In fact, it could be a buy at the dip opportunity. So what to do with all this information? Let's bring it together. Let me give you the forward-looking framework because the story is going to keep developing. The first thing I'm watching is the Fed. The recent sell-off wasn't random. A stronger-than-expected jobs report hit the market, and suddenly rate cut hopes evaporated. The 10-year yield surged, and high-growth stocks felt it immediately. Now, If the Fed signals rates are staying higher for longer, then there is a real headwind for this sector. Not any reason to abandon it, but something to watch closely over the next few months. The second thing I'm watching is the Zen ratings on these names specifically. That's always my primary signal. When a stock I own starts slipping in the ratings, especially because of a weakening of future growth expectations, that is my signal to get out. Not just the noise and nonsense that comes from daily price action. Right now, both Micron and SanDisk are seeing rising earnings estimates, not declining, and thus they continue to be buy recommendations in my Zen Investor portfolio because of that likelihood of more upside ahead. The moment that changes, I'll be taking my profits and sharing that insight with all. For now, it remains a green light to race ahead. Listen. The Bank of America strategist is right that parts of this market have gotten way ahead of themselves. The valuation risk in the crowded AI trade is real. Investors who are sitting on big gains in the mega cap names should be thinking carefully about that, as in taking some profits off the table now and then having a trailing stop in place in case the bottom quickly drops out. And note that outside of tech, there are much more reasonable valuations, especially in small cap names that offer excellent upside potential. The Zen Ratings does an excellent job of unearthing these hidden gems, so be sure to visit WallStreetZen.com to get more of those timely ideas for your portfolio. Now I want to hear from you. Do you believe there's reason for caution in the big tech and AI stocks? And what is your view on the unique outlook for the memory stocks like Micron and SanDisk? Are you bullish or bearish? Please share your thoughts in the comment section below for the benefit of our community. And if you like this timely market video, be sure to check out another recent release that is still relevant. My take on quantum computing revolution is coming up on your screen now.